Now, we also have to take a look at our own situation. We are apparently the wicked wastrels of the Western world. I want you to understand it took me 1 hour to come up with alliteration. I just hope you appreciate it. And our issues are our debt to net worth ratios are the highest they've ever been. Our debt to income ratios are the highest they've ever been. We've got the press and the media all terribly concerned about how much debt we're taking on and how profligate we're being as well. We have, of course, our leaders, Jim Flaherty and Mark Carney, worried about the fact that now our debt ratio is finally overtaken that of the U.S. consumer, presumably the most profligate consumer in the world. And here we are, now in victory, but we always like to beat the Americans, but maybe we could come up with a better game than this. So our challenge here is, and I looked at these numbers, and I've seen these headlines for quite some time now. My challenge with them is they didn't sort of jive with other data that I was looking at from StatsCan and other sources. Like I was seeing some inconsistencies here. I know our government federal fiscal position is much more solid than the U.S. The corporate situation in Canada is very strong, as it is in the U.S., and it was hard for me to reconcile this issue here. We never had a housing bubble to the degree that the U.S. or Ireland or Spain or the U.K. did. So how is it that we managed to get ourselves into this mess? And I wanted to know, I talked to StatsCan and I started to ask them about how the data is compiled. And I'm going to do my best to not make the next 2 or 3 minutes totally boring. Okay. So remember we took a look at this image? Well, I want you to consider these images and look at it from a different perspective. This is the savings rate in Canada shrinking from 1990 to 2090. We had a 14% savings rate back then. We have a 5% savings rate today. So clearly, saving less money. Now, we're not the only country saving less money, but we're saving less money as a percentage of our income. But on the other hand, while we're doing that, our net worth to GDP has gone up by 50%. Now, for your net worth to rise faster per person than the actual economy grows means somebody is saving money. So that's a disconnect with this first slide shouldn't make that happen, but it does. And in fact, our net worth as a country, according to Stats Canada, has tripled in the last 20 years, and after inflation, it's more than doubled. So in other words, we are actually quite a wealthy country with a significant amount of assets in relation to our debt. But our debt has been rising. Nobody can question. These are hard facts. The Bank of Canada has these mortgage rates, are 150% higher mortgage debt over the last 10 years alone. And at the same time, The Economist has done a study that says Canadian housing prices have gone up 60%, maybe obviously more in Vancouver, but on average across the country, 60%. Again, if your mortgage debt is going up 2.5 times faster than your price of your house, it means then your equity in your home has got to be shrinking. Mathematically, it has to be that way. Except when you go to Stats Canada, they say it hasn't changed in 20 years. Our equity, the average equity a Canadian has in his home is exactly the same as it was 20 years ago. So again, it's hard to see, well, okay, so where's this crisis? You know, there's a disconnect in the numbers. So I came up with my own theory. I've actually put it to the people at Stats Canada. They're not sure how to deal with it, so I have to tell you this is my pet theory, and it relates to the fact that we have a number of clients who are incorporated professionals and business owners, like many of you here, and I went to Stats Canada and I said, okay, let me give you a scenario. You tell me how you measure this. So the facts are this situation. This client is incorporated. They make $400,000 a year. They take dividends of $250,000 a year because hopefully they're still listening to us. They save $100,000 corporately. They're not buying any RSPs. This individual dentist has $500,000 line of credit. He used it to expand his practice and for some investments in his company, but it's a line of credit mortgage on his house. And his practice is worth $750,000 and $500,000 of that's goodwill. So those are the facts. From Stats Canada's perspective, the following is true. The income that they show for the purposes of measuring his everything from his debt to income ratio to income as a country is only the personal income he takes out of his corporation. Any other money he leaves in his corporation does not count at all. Savings are considered zero because he saves 100% of his money in his corporation, and none of that counts in the personal savings rate. Mortgage is considered to be personal debt because they don't distinguish between a mortgage taken out for investment purposes or business as opposed to a mortgage for consumption purposes. The goodwill is not part of his net worth at all, so it doesn't even figure into the ratios. So you can see what the problem is. There's an awful lot of wealth, and it may say, well, this must be true for lots of countries. Well, specifically, we have very generous rules for professionals and business owners on how corporations can be used to build the business and to acquire and build wealth. These rules do not apply in any significant way in the U.S., for example. So most corporations in the U.S. are see-through vehicles. They basically pretend the corporate vehicle doesn't exist. So where's the money? Well, what you're looking at is a graph from Stats Canada, which were like gleaned from Stats Canada. Theirs aren't quite as pretty as this one, of how corporate savings have changed in Canada from $19 billion to $90 billion a year in the last 20 years. Much faster growth rate than the economy. Whereas the savings rate, as I mentioned, has gone from 14 to 5%. And the argument I'm making, which is very, very difficult to prove, is that some of those personal savings are now in the corporate pot and not being measured as personal savings. So I'm not sure that we're looking at the entire picture. I'm not sure we're quite as profligate as we think. And in any event, I feel better about just feeling it that way anyway. So Rob talked about housing prices. I want to just briefly touch on housing as well. This is The Economist, just came out with this a couple of days ago. Their survey on housing shows, if we take a look at certain bargain countries, Japan and the U.S. now, their housing is considered to be undervalued. That is to say, the housing prices in relation to the rents on those homes are below fair market value. This is the first time we've seen that for the U.S. for a long, long time. So even though the market may drop, as Rob pointed out, the fact is that from a rental perspective, fair value has been achieved. We are slightly overvalued, but not as much as we were last year. So I suppose that's good news. And there's a lot of countries that are still way off the charts as well, still potentially in a bubble. One of the graphs I saw recently in the Wall Street Journal was one maybe helps explain. A lot of people blame the housing bubble in the U.S. primarily on very, very cheap interest rates, and I'm sure it was a big factor, but it's not the only factor. This shows, from a banking perspective, how much banks now demand as a down payment median. The average down payment on a house in the U.S. now is 22%. At the height of the bubble. If you take a look at various cities in the U.S., you've got a whole bunch of cities here, Las Vegas, L.A., San Diego, Stockton, Washington, where for a period of time, the average down payment required was 0. Well, gee, okay, some guy's renting a house, and you're saying, would you like to own a house? We'll give you some money. Okay, well, you don't have to. Do you need some furniture? Do you need closing costs? Do you need a taxi to get there? Whatever you need, we're going to get you in this house. Well, gee, how hard is that decision? So part of the issue is you create a marketplace. It's not simply the low interest rates that drive markets. It's the amazing ease of credit. And obviously, this is a good example. Well, that is clearly reversed. And as a result of that reversing, there is this new normal, not quite, as Rob points out, back to this long-term trend from the Schiller index, but getting close. That is also meant, because home ownership is dropping in the U.S. from a peak of 69 now to 66, likely to go down to the low 60s, is that renting is increasing. And that's a strategy that's important to us because we have real estate investments in the U.S. focused on the multifamily rental marketplace. So every time you have a 1% drop here, you are losing 1.2 million households that own a home who are now going to rent a home. In addition, there's about 1 million households every year being created in the U.S., so that's over 2 million households a year looking for rental accommodation. And rental accommodation is the only accommodation in the U.S. that has any inflationary traction at all. So from our perspective, from an investment perspective, we're looking not to try to buy bargain houses that are being sold, to busloads of tourists going around looking for foreclosures. We're looking for multifamily residential with our partner Venterra in the U.S. So just a quick summary of SPIRE. Many of you have invested in SPIRE over the years. Last year, we ended the year with 193 million of assets, 112 million of capital. So we have a leverage in the partnership of less than 50%. So we like to keep things pretty conservative. The return last year was 11.3. It's been 9.6% since its inception in the 2005. We are currently in the process of acquiring $40 million of new assets in Canada, which we're very comfortable with, and $15 million of new capital has gone in just recently. In the U.S., the situation is we have a much smaller presence there. We have a $50 million pool, $16 million of equity, $5 million of new capital has just gone in. The return last year was far more modest. It was just the income distributions only. But my belief is that the long-term returns for real estate, the long-term potential capital gains returns for real estate, for the kind of real estate we're looking at, are more likely, interestingly, to happen in the U.S., partially because I believe that the multiples, the cap rates are more attractive from that perspective, and the future for the demographic issues in the U.S. are very strong. But I also believe that because our dollar is so strong, it's important to diversify away from the strength of that dollar and not just take it for granted. And we have undivided interest in over 6,000 rental units now, in the American Southeast. What's the right percentage to own in real estate? Well, this again is from the latest Economist survey on property. It shows that, interestingly, the actual value of global real estate, this is in the developed world, is exactly the same as the total value of all of the equity markets of those same developed countries. In theory, then, a balanced portfolio would have the same weighting in real estate, investment-grade real estate, commercial real estate, as they would have in equities. Very, very few investors do. So obviously, there's a number of people who basically probably only have real estate, and then the rest of investors have very small percentages in real estate, probably typically 5 to 10% or less. We think that number should be considerably more. And over the years, these are the returns. You've seen some maybe in the past. These are up to the end of 2010. So this is what $100,000 has grown to with ourselves and a number of our very worthy competitors. The one that we look at the most, this is the Globe Peer Index and the index returns. These are balanced portfolios in traditional weighting for asset allocation, bonds, stocks, global and Canadian. The two things that we feel are the most important from an asset management and a return perspective are that the average of the indices, they dropped 11% in 2001, 2002, and 18.5%, obviously, in the big debacle in 2008. In the same time frames, we were actually up 2.5% in this same period of time and down 6.5% in 2008. The reasons for this, in our opinion, are a combination of the asset allocation and the cash flow. And what that means is it means that we have something called a standard deviation. The only thing I need to tell you about this number is this is one of those charts where the lower your number is, the better you want. This is the least amount of risk. This is the greatest amount of risk. So one of the things we're trying to do is to reduce the volatility of a portfolio because investors are likely to behave better and be more patient about where their returns are coming from if their portfolio is not jumping all over the place from a value perspective.